What's up, my mind your money business folks? It's me yet again with another video. And as you can see by the title, we're talking about investing and why you should invest into the S&P 500. Yes, I said it, the S&P 500. I'm not a professional financial advisor or planner. I'm just someone who's created a YouTube channel to give opinions and research information on investing. Yeah, that's all I'm doing. So let's get into this, right? This article was posted by Merrill Lynch. It said, during times of market turbulence, a key piece of advice is often to lean towards stocks of large, high-quality companies. Major firms with proven earnings and strong balance sheets have historically tended to prove stability, consistent returns, and dividends. NVIDIA, says Chris Hizzy, Chief Investment Officer for Merrill and Bank of America Private Bank. In the United States, the world's largest equity market, Hizzy's description could be captured in a single phrase: the companies listed in the S&P 500. Those companies are stable. They have a historic track record of doing well. They have good returns. Some pay dividends. Yeah. Over time, this index of major U.S. companies has proven remarkably resilient, even during the global pandemic, rising geopolitical tensions, natural disasters, and the war in Ukraine. U.S. equities represented by the S&P 500 index are higher by 233% on a total return basis over the last 10 years. Says Marcy McGregor, head of CIO portfolio strategy in the Chief Investment Office, Merrill and Bank of America Private Bank. These are the professionals telling you this. This isn't me pulling this out of thin air, providing you with what I think. This is what they're tracking, and this is what these professionals know. Okay, while past performance doesn't guarantee future results, that is true. The returns of the companies on this index over the period of time are impressive from a historical perspective, notes Kristen Kabakungan, an investment strategist and the CIO for Merrill and Bank of America Private Bank. These people, these professionals are providing this data and this information because this is what they track. And it's posted on their website. A selective list. Though numerically just a small portion of the more than 3,500 publicly listed companies based in the United States, S&P 500 companies represent about 80% of the total U.S. market capitalization. That means how much money is worth. Like, I think Microsoft has a capitalization of their worth, right? Microsoft is worth about 3-point-something trillion dollars. Apple is, I think, the second company that's worth the most. I think they're over $3 trillion. NVIDIA is third. Yeah. So either way, yeah, it's all, the capitalization is all about how much the companies are worth. So it says, thus the index created in 1957 is widely regarded as a proxy for the broader U.S. equity market. The rich created these things for themselves, people. Again, they created a plan. They created a game for them to make money. So are you going to join in the game, or are you just going to stay on the sidelines and watch? To be selected for inclusion in this index, companies must have at least 15.78 billion in market capitalization. They have to be worth $15.78 billion as of March 28, 2024, have positive earnings in the most recent quarter and year, and meet a host of other standards. The list is continually updated by the S&P's U.S. Index Committee as companies expand or decline, and this regular refresh may help to explain the index's historical resilience in the face of market pressure. That's why it's good to invest in the S&P 500, right? The managers of these funds, whether it be Fidelity, Charles Schwab, Vanguard, they manage these funds. And if a company's no longer performing well, or they no longer have a market cap of $15.78 billion, those managers of those funds will remove those companies and replace it with one that is meeting those standards. And I believe just recently, Palantir was added to the S&P 500. So if they were added, that means someone was removed. Who? I don't know. But someone was removed. And they're saying because these funds, these S&P 500 indexes are managed, it helps, the positive returns that are brought back every year, year after year. Because let me see, I think I have something. Oh no, I'll wait until I say that. But either way, yeah, a benchmark for quality, yield, real returns, and more. McGregor and Kabakungan point to some additional underlying qualities that make the S&P 500 such an important benchmark and share some points for investors to consider. They include quality. S&P 500 companies are often considered most representative of the key industries in the industry, and they tend to be large cap stocks with relatively higher quality and stable businesses, like a Microsoft, like an Apple, like an Nvidia, like a Meta, like an Amazon, like Palantir. Who else is a part of the S&P 500? Yeah, Google it. Okay, yield. Many companies in the S&P 500 pay dividends to shareholders that can offer an alternative form of income in addition to any income investors receive from their bond holdings. What is a dividend? I'm glad you asked. And how does a dividend work? Dividends are the percentage of a company's earnings that is paid to its shareholders as their share of the profit. Because you're buying stocks from that company and you're a shareholder, some stocks pay you, or some companies pay you dividends. And dividends are generally paid quarterly, with the amount decided by the board of directors based on the company's most recent earnings. That's right. Access to secular growth. The U.S. is a global innovation juggernaut and home to world-leading technology firms like no other country. People, take advantage of this wealth that exists in the United States if you're in the U.S. Stop paying attention to things that don't matter. Make decisions that do matter for you and your family, right? Invest. Many businesses listed in S&P 500 now harness the power of technology and automation and are found across all sectors. Real returns. While inflation affects individual companies and industries differently, the S&P 500 over the long term has historically provided positive real returns, or the amount earned after accounting for taxes and inflation, as companies have become more productive and able to pass higher costs on to consumers. Even during the great inflation decade from 1970 to 1981, consumer prices rose by cumulative 117%, but the S&P 500 total return was higher at 125%, notes McGregor. So even though the prices of goods and services went up during 1971 to 1981, had you been invested in the stock market, even though prices were going up, you would have made more money had you been investing. You would have made 125% return over those years. Okay, a foundation for consistent earnings. Because of the stringent requirements for inclusion in the S&P 500, the companies listed in the index tend to be those that have generally kept up with long-term structural changes in the economy. Like, they're not a dinosaur company where because they offered a product like Blockbuster, they're still in business. No, like Blockbuster did not keep up with the changes that were being made. So someone like Netflix came along and knocked them out because everything's online now. So yeah, that's a good example. I just thought of that. All right. Okay. Durability during and after recessions. Consider the last 4 recessions. The S&P 500 tended to perform better on average in terms of price return both during and 12 months after the start of the recession compared with global peers and commodities. And that is where I want to talk about this. Now, before the pandemic, in 2018, S&P 500 returns were at a negative 4.23%. Then the pandemic happened in 2019. Did it happen in 2019 or 2020? I think it happened in 2020, didn't it? Because I was in Dubai for Christmas of 2019. Exactly. So returns in 2019 for the S&P 500 was 31.21%. Then the pandemic happened in early 2020. Stock prices dropped, so on and so forth. But 2019 also started to recover later that year, and the S&P 500 provided 18.02% return. Then a year later, it increased in 2021 to 28.47%. So just think about if you were investing in the stock market during those times, you would have made a lot of money. And that's what I did. I started investing in my own, stocks, other outside of my company's 401k in 2020. And I've made significant gains on my stockbroker's account. Okay, ongoing reinvention. Creative destruction, or the process of constant reinvention as emerging companies become eligible for inclusion and others drop off, has transformed the S&P 500 over time. Kabakungan says, in 1969, individuals represented a third of the index. Today's leadership composition of the S&P 500 differs substantially from decades prior. In 1990, there was more varied mix of sector leaders across energy, industrials, healthcare, and few technology names. Today, the latter sector dominates. Technology dominates the stock market. Company size has skewed so large that, in fact, the top 5 largest stocks in the S&P 500 are each of greater value than the entire technology sector in 1990. I'm telling you, technology is booming and is going to continue to boom with the likes of Meta, Nvidia, Apple, Microsoft, Amazon. That's all I can think of. Yeah, technology, like they're calling Nvidia, artificial intelligence, the 4th industrial revolution. I'm not calling it. That's what the experts are calling it. Google it, right? Okay, so what the S&P 500 might mean to you people. If you own individual large cap stocks, you may likely be invested in one or more companies listed in the index. Many index-based mutual funds and exchange-traded funds invest with the intent of tracking or mimicking the yearly performance and own all 500 of the index's stock. And because it has such broad exposure across sectors, the index is a useful benchmark, offering insights on the overall strength of the markets and the economy. But here's a reminder. The S&P 500 companies don't guarantee results. Hizzy says, all investments carry risk and are subject to challenging conditions, including periods of heightened market volatility, such as what we saw in 2022. Yeah, 2022 sucked. It sucked. But the article also says, nor should investors focus solely on the S&P 500. Stocks of smaller, promising companies and international equities can offer important potential growth opportunities for investors, while bonds and other assets are essential for diversification. Because again, the S&P 500 only consists of the 500 largest companies in the United States. However, there are other companies out there that are doing well too, that are also bringing about good return. That's why I suggest VTSAX, which is the Total Stock Market Index Fund from Vanguard. It covers the entire market. It covers large cap companies, which is the S&P 500. It includes mid cap companies, small cap companies. It has over 3,000 companies within that one package. And then the people at Vanguard, they manage it. If there's a company that's not performing well in the large, mid, or small cap package, they will remove it and replace it with one that is, to ensure that you're making money. Because as you make money, they make money because they charge you a fee for managing the fund. That chip is good. Okay, bottom line. While there will always be volatility and results may vary from year to year, McGregor believes S&P 500 companies will continue to offer important benefits for investors, given their improving productivity, proving durability, higher quality, and consistency of earnings growth. We believe, they believe, not me. These professionals, these experts believe this group of companies should be considered as a core holding for long-term investors. Yeah. And I'm in it for the long haul. I may continue to invest in the S&P 500 until I take my last breath, because I won't need the money. And like I said, and how I read in here, a lot of these companies within the S&P 500 pay dividends. They pay dividends, and most dividends are paid out quarterly. And some people who have been investing for a very long time, they live off of their dividends, at the age of 65 or maybe 50, 60, depending upon how long they've been investing, or their family started investing on their behalf when they were born. And now that, they're 55 years old, they're like, you know what, I have enough money. I have enough. I have thousands of shares of this particular stock that's paying me a dividend, and I'm receiving $15,000 a quarter. That's $5,000 a month. They may say, no, I'm not working anymore. It just depends. You may have some people have, what they're raking in $20,000, $30,000 a quarter from dividend payments. Coca-Cola pays dividends. I believe Starbucks pays dividend. Nvidia pays a small dividend. There are some real estate stocks or REITs that pay dividends. Yeah. So I just wanted to get on here and do this video. I think I'm going to turn in early tonight. Yeah, just because. But I wanted to do a video, and now that I'm done, I'm happy that I did it. Because there are a lot of times where we may want to do something and then we find reasons not to do it. But then if you push yourself and do it, you feel a lot better. And I actually feel better that I've done this video. So I'm going to end on that note. So like, comment, subscribe, share this video. Let me know what you think, if you think anything at all, because I hope you are thinking, people. Think, think about the future, or what you want the future to look like. Stop sitting on the sideline and thinking about the past and believing that nothing is possible for you. Because just understand that thinking about the past keeps you in the past. If you didn't have anything in the past, and if you're constantly talking about the past as time moves on, you're not going to have anything in the future either. So you have to see yourself having the things that you desire and want out of life. You also have to create a plan in order to get said things, whatever those things are. Like, you don't need to rob Peter to pay Paul. You don't need to take what someone else has in order for you to be happy. You don't need someone else to hand you or give you a handout. You need to create your own. Creators are respected. Yeah, okay. All right, so I'm going to leave. I'm going to end on that note. All right, so you guys take care. Peace.